Ondas Holdings closed at $7.41 per share on Thursday, July 2, 2026 at 4 p.m. EST, marking a significant decline of 6.44% during a high-volume trading session that saw over 87 million shares exchange hands. While many casual retail investors logging into their online investment accounts over the weekend might assume this drop is just standard tech sector volatility, there is a massive structural disconnect playing out underneath the surface that your average stock forum is completely missing. Everyone wants to talk about mega-cap options like Tesla stock or Apple stock, but small-cap tech plays are experiencing a violent tug-of-war between stellar contract wins and aggressive balance sheet dilution. The immediate expectation for this company has been overwhelmingly positive because their order book is absolutely exploding with massive contracts, including a high-profile drone defense deployment for the 2026 FIFA World Cup and a $68 million military engineering order. However, the sobering reality hitting the market right now is an unprecedented push by management to expand their authorized share capital to a staggering 1.2 billion shares. When you look at the heavy trading volumes over the last few days, it becomes clear that large institutions using Interactive Brokers platform or executing orders through Fidelity Brokerage are actively repricing the extreme dilution risk against the company's backlog. The typical retail narrative says that a company growing its revenue tenfold year over year is a guaranteed winner, but sophisticated players understand that massive top-line expansion means absolutely nothing if current shareholders get wiped out by continuous equity issuance. If you look at the recent daily swings, the stock has collapsed from its early June highs near $13.50 down to this current $7 range. This 41% drop occurred right alongside a broader technology and semiconductor sell-off, where major market leaders like Nvidia stock faced intense selling pressure due to shifting expectations around infrastructure spending efficiency. For a small-cap firm like Ondas, macro pressures get amplified tenfold, causing sudden spikes in daily trading volume that frequently trigger alerts across major investing sites and retail apps. People tracking their portfolios via the Robinhood investment app or utilizing tools for self-investing are seeing wild technical fluctuations, with the moving average convergence histogram turning negative while the relative strength index flashes oversold signals. This creates an incredibly confusing environment for individual brokerage accounts because the headlines trumpet major partnerships such as their Sentrycs subsidiary collaborating directly with Lockheed Martin on counter-unmanned aerial systems, while the price tape tells a completely different story of relentless distribution. The market expectation was that these high-profile defense partnerships and a rising pro forma backlog of $457 million would establish a firm price floor. Instead, the reality of cash burn and massive insider selling has shattered that thesis. In a move that shocked many analysts tracking the company through professional platforms like Interactive Brokers trading systems, the chief executive officer sold nearly $32 million of company stock right as the valuation peaked. When the leadership team drops that much equity into the open market while simultaneously filing proposals to radically expand the share count, institutional desks at Fidelity Investments and wealth management offices start quietly backing away from the bid. This creates a supply imbalance that easily overpowers the casual buying coming from retail traders participating in online investing through platforms like SoFi Invest or using automated guidance via Schwab Intelligent Portfolios. To really understand what is happening here, we have to look past the daily chart and examine the actual business model. Ondas operates a dual-platform strategy focused on state-of-the-art private wireless networks and autonomous drone-as-a-service systems for critical infrastructure and defense. They recently finalized a $125 million acquisition of Cyberhawk to add proprietary data and software capabilities, complementing their existing platforms like Worldview high-altitude balloons and their automated Iron Wave defense architectures. On paper, assembling an end-to-end aerial intelligence platform makes immense strategic sense, and it is exactly the kind of story that looks incredibly attractive when displayed on a Robinhood stock trading interface. But looking at older financial reports, the operational reality shows a company running a deeply negative earnings before interest, taxes, depreciation, and amortization of negative $74.6 million. They are effectively funding their massive acquisition strategy by using their own stock as a currency, which continuously lowers the value of every single share held inside an individual brokerage account. Please take a brief second right now to participate in our channel discussion by responding to this specific question. Comment below how many shares of Ondas holdings you currently hold in your portfolio, and tell me if you are buying this dip or cutting your losses. This tension between incredible commercial validation and severe structural dilution is exactly why the stock is behaving like a roller coaster. Investors who rely on simple stock screeners or look for basic investment help on mainstream platforms often fail to weigh these competing forces properly. If you are managing your retirement capital through Fidelity IRAs or relying on an intelligent portfolio to allocate your assets, a hyper-volatile stock like this requires an intense understanding of corporate governance. The company's revenue reached $96.6 million in their recent reporting, but when a business requires continuous external capital to survive, the path to actual profitability becomes highly elongated. This explains why institutional short interest has remained sticky, using interactive brokers' stock trading tools to hedge against the downside, while retail investors try to catch a falling knife using the basic tools on their Fidelity mobile app. Looking forward, the future outlook for the company depends entirely on whether their execution can outrun their dilution. There are a few distinct scenarios that could play out over the remainder of 2026. If the company successfully integrates Cyberhawk and starts converting its $457 million backlog into upfront cash flow, they might drastically reduce their reliance on secondary public offerings. That outcome would immediately catch short sellers off guard, causing a violent short squeeze that would show up as a massive green candle on the Fidelity trading platform or any standard chart layout. On the flip side, if the cash burn persists and they fully utilize that 1.2 billion share authorization, the persistent dilution will continue to act as a heavy anchor on the per-share value, keeping the stock depressed regardless of how many new contracts they sign with the military or international border programs. For anyone practicing active self-investing, navigating a corporate profile like this means you must tune out the emotional noise on social media and look strictly at the numbers. The general consensus across retail forums is that this company is a hidden gem because of its involvement in cutting-edge defense tech, but the cold reality is that the financial structure resembles an aggressive roll-up strategy that carries immense execution risk. When evaluating where to place your hard-earned capital, comparing a speculative small-cap asset to established giants like Apple stock or Tesla stock highlights the massive risk premium required to hold this position. If you choose to trade these swings using a Robinhood Investments account or a sophisticated interactive broker's account, you have to be comfortable with the fact that a single regulatory filing or insider sale can wipe out weeks of technical gains in a single pre-market session. Ultimately, the story of this asset over the past quarter perfectly illustrates the ongoing battle between narrative expectations and fundamental reality. The market expected a smooth upward trajectory driven by defense orders and global drone adoption, but the reality delivered a lesson in corporate finance, cash burn, and the heavy toll of share dilution. As we watch how the trading volume settles into the late summer sessions, keeping a close eye on the upcoming quarterly earnings report on August 11th will be absolutely essential. That report will show whether the cash flow metrics are finally starting to improve or if shareholders will need to prepare for another round of capital raises. Managing expectations against these hard financial truths is the only way to protect your individual brokerage balance from getting caught on the wrong side of these violent small-cap market cycles. Keep your eyes on the data. Monitor the institutional flow through your chosen investing sites, and never let a compelling headline blind you to what is actually written in the regulatory filings.